So today we'll talk about the third homework, some of the general mistakes that I saw there. I want to address a couple of things about the last part of the project because that's also going to tie to your fourth homework assignment. All right, so this was just continuing looking at Pepsi's 2018-2019 financial statements. All right, so did Pepsi have more debt financing at the end of 2018 or 2019? So for this, we'll look at the balance sheet. Just put this little aside here. And debt is going to be equal to short-term debt obligations plus long-term debt obligations. All right, and there's two general mistakes that I saw being made here. One was people were looking at total liabilities and then just comparing those two. But keep in mind, total liabilities includes some items that are not debt. Right, so for example, accounts payable. This is Pepsi owes some suppliers money. They haven't yet paid that money. It's not a debt obligation. Right, similar with deferred taxes, other liabilities. And so explicitly, debt is the long-term debt obligations, short-term debt obligations. All right, so adding those two together gets us the total amount of debt that the company is relying on. One other answer that I saw that I think technically works out okay, right? More debt financing at the end of 2018-2019, where people looked at the amount of debt specifically issued in each of those years. So that wasn't exactly what this question was asking, but I appreciate that other way of looking at this problem. All right, the second question, was Pepsi more profitable 2018 or 2019? All right, the big mistake that I saw here where people were simply comparing the net income across these 2 years, right? But like I've been harping kind of throughout this term, this is kind of the first step. What's a better way to evaluate the bottom line here? What's a better way to compare across different years, in other words? Exactly, yeah. Right, so there are many ways we can break this apart, but simplest one is going to be just to look at the profitability ratio. In this particular year, it happens to correspond directly with the bottom line, right? 2018 had nominally higher profits. It also had higher profits relative to the revenue. So you happen to arrive at the same answer. But there are other ways that we can look at the profitability of a company. Right? One additional step we could take, and probably the best way to go about it, is to make adjustments to net income that arrive at what's the actual value being created or destroyed. How do we actually measure value when we're evaluating an asset? Right, there's an adjustment that we have to make to net income. We don't focus on net income for valuing an asset. What is the measure we use? It's a non-GAAP measure. Walmart uses the lazy method. Free cash flow. That is the best metric to gauge a company's performance in a given time period. Right? It adjusts for the true timing of cash exchange, and the timing of cash exchange is material to the value of that cash exchange. The timing of cash matters. The earlier you receive a cash inflow, the more valuable it is. The later you receive a cash outflow, the less value destroying it is. All right, so if you were to measure this as free cash flow, that would be the best metric to gauge how valuable a company was in a given year, how much value they created or destroyed. All right, so just looking at the bottom line net income, that's kind of the starting point for getting it correct. Going the next step, taking income relative to revenue, relative to assets, something like that. That's going to be a better step because we need to take ratios over time to be able to compare companies to its historical performance. Right? We need to get that relative basis to measure the value being added or destroyed. And then the best way to have answered it was looking at the company's cash flow in those given time periods. Right? We know income is related to cash flows, but there are adjustments that we make that typically net income is not directly equal to free cash flow. All right, and it used the direct or indirect method. What would happen if you switched methods? Right. So for this, go over to the company statement of cash flows, and you just look at the operating performance of the company. Right. So you have the direct and the indirect method. The direct method starts with revenues at the top, adjusted for cash changes. The indirect method starts with net income at the top. So this was the indirect method. Regardless of the method that you use, you should arrive at the same operating cash flow. It's just two different ways to arrive at the same result. Right. Why was cash flow less than net income in 2018, but more in 2019? All right, so here we basically have to look at what is in between the top and bottom line of this question. All right, so what are the major differences we see coming out here? Right, so far not much. All right, looks like pensions are a significant part, but the largest factor are taxes. Right, the biggest difference between 2018 and 2019 are the tax benefits related to reorganization. All right, so as you're going through line items, just keep an eye out for what is the most drastic difference. Right, in this case, there's not much of a difference up until we get to pensions and then tax changes. Right, so those two line items are the largest explanatory factors in the difference between net income and operating cash flows in those time periods. And lastly, why was cash flow from investing activities positive in 2018? All right, so we have to go to investing, right? Yeah, investing activities. All right, so we're looking at net cash provided by investing activities. We have a positive value in 2018, right? And like I mentioned, usually investing activities is negative for companies that are growing, right? They have to invest in growing assets, so their capital expenditures are usually going to be the largest factor here. In 2018, though, there was not a large change in capital spending, but there was a large inflow from short-term securities. Right? This resulted in there being a positive investing cash flow in 2018. Right? So again, when you're looking at the performance across different years, you can look at what are the largest changes. Right? There happened to be a large cash inflow the previous year, but there was a larger sell-off that outweighed that inflow. All right, any questions about your homework? All right. So on the project, I left specific notes on things that could have been addressed in a better way. Right, you're basically asked to look through MD&A and use that information along with the analysis you've already done optimally to try to describe what happened over this time period, right? And like we were talking about going through Walmart's MD&A, after you've done something like the cause of change analysis, you can pinpoint where exactly the changes were, but MD&A should supplement the why for that occurring, right? So for example, when we look at the effect on cost of goods sold on the bottom line for the company. Right? Management and discussion analysis told us why this was happening. It was a mixture of inflationary pressures in the supply chain, write-offs, and there was one other really significant factor I can't remember off the top of my head. But MD&A provided that reasoning why this change occurred, right? Why cost of goods sold increased on a proportional basis. Right? So that's kind of the benefit and the motivation for going through MD&A is to try to figure out why exactly you observed what you did in your financial statement analysis, right? You should be getting additional information in there. I noticed that some people, it kind of looked like they weren't actually going through MD&A. They were explicitly just talking about basically news headlines that are commonly associated with companies. But when you dig into the MD&A, it provides a lot more detail and reasoning on the company's operations and any significant change in that operation over this time period. And a big part of bringing this up is your last homework is going to be going through another MD&A, but this time of a company of your choice. And I'll send out an email to specify this. Choose a company that's not in the industry that you've already been assigned, and I'll send an email detailing that. But when you go through this MD&A, just make sure you bring up the important bits of information that you're getting out of that. Management is going to discuss cash flow, operating performance. They're going to discuss significant changes in costs and likely issues that the company is going to face in the near and long term in the future. So as you're going through this, make sure that you're explicitly getting this information and tying it into your report, right? Because you don't want to just talk about general, the company performed well, the company performed poorly, that sort of thing. Provide details on why exactly that performance improved or deteriorated over a given time period, right? It's that explicit and concise bit of information that's going to be really valuable as a financial analyst, but also for the people that are digesting the information that you're evaluating, right? As a financial analyst, you're going to have to provide this information to decision makers who are going to use it to try to improve the performance of a company. So being able to pinpoint what exactly is relevant information is extremely important. And we're going to talk a little bit more about that today. All right, so any questions on the homework or last part of your individual section of your project before we move on? Yes. 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 But you're not going to have the cause of change analysis available to you to know what you're looking for. Yeah, pretty much. Yes, but I also recommend look at the notes that I left. If your step 4 was great, then I didn't have any information to give you. But if I left you notes in your grade book, then make sure you go through that and improve on that for the homework. Yes. Yeah. 1 to 2 pages should be fine. Yeah. One thing that I'm going to point out today is very often there's more information than you really need in financial statements. Right? When you're evaluating an asset, very often you can just use a couple financial statements, modify it if there's relevant information in something like MD&A for something like terminal growth rates and discount rates. But a lot of the information can be boiled down to 1 to 2 pages of relevance. So it doesn't have to be long, but just explicitly pointing out what is important information that you're finding in there. Yep. Any other questions? All right. All right, so when we're looking at financial statements, we need to be looking at stuff that provides useful information, right? And there's a lot of qualities to financial statements that result in this. All right, so by useful, we're talking about being able to make decisions. As a creditor, when you're looking at a company's financial statement, are you able to gauge whether they are actually creditworthy and capable of paying back debts that they're choosing to take on? All right, so can you use this information as an analyst, as an investor, as a manager? Can you value a company's cash flows relatively easily with the information that is contained in financial statements? Is it relevant to the company's performance? Right, so like we're going to see in a little bit, there's a lot of information in financial statements. Not all of it is relevant, but you should be able to get all of the relevant information out of financial statements. Right? You should be able to gauge a company's performance. You should be able to understand its cash flows, especially when supplemented by MD&A to figure out what actually is going on in the company and how well is it performing. Right? By faithful, we're talking about does the information in our financial statement actually reflect the company's performance? Right? And this is a really important aspect, and hopefully companies that you evaluate are meeting all these criteria. But it has to be a representation of the reality experience, right? That's what financial reports are about. They're trying to reflect the reality observed over a given time. Right? By material, it's important and meets the other categories already discussed. Is it including all of the information? Right? And this is part of the motivation for including cash flows in the big three statements now, right? Income statement, balance sheet, cash flow statement. It's possible to reflect information in the income statement and balance sheet in a way that kind of can cover up poor areas of performance, right? But if you are going to value a company from any perspective, it doesn't matter if you're inside, outside, creditor, regulator, you need the full picture. If you don't have complete information of the company's performance, then you aren't able to accurately gauge whatever decision you're going to make in regards to this company. And it should be impartial, right? Right? People being people, that's not going to be the case for companies when they're putting together financial statements. There's an inherent bias in our psychological makeup, and people are going to tend to view whatever they're engaged in a positive way. But there are steps we can take to try to make it as neutral as possible, especially when we're following along all of the previous steps. Right? We need to provide all the information that we possibly can, even if it's bad information, even if it results in reflecting poor performance in a given area. It's important that we provide that information as accurately as possible. So keep this in mind. Right? We're humans. We're biased. We're not going to be able to be completely neutral in a given matter, but to take steps to try to be as neutral as possible. Right? And if something changes, statements have to reflect that change so that all of this information stays true. Right? And as we know, things change over time. Right? And there's a specific way that financial statements will be changing. Right? One thing I also want to talk about is the quality of the reports themselves versus the quality of the performance of the company. Right? And these are two separate things, but they are going to be closely related. Right, so quality of earnings, or in another word, firm performance over a given time period. This is a reflection of how sustainable is the performance of a company. Right, so specifically, the proportion of earnings that can be maintained in the future. So what I mean here, I don't remember. Sorry, no, is when companies have a growth in revenue, is that revenue growth from improved performance for the company, or are they just incidental economic performance? Right. So a great example is that is the growth in revenues purely from inflation. Right. That was one of the things that was noted in Walmart's MD&A. Some of the revenue increase was purely a mechanical factor of inflationary pressure. Right. And inflation is going to affect all companies, some degree or another, but it doesn't reflect improved performance on the company side. Right, just because you're selling something that happens to have increased in price is not a reflection of you being able to sell that product in a more efficient way, or being able to sell more products in a given way. Right, so quality earnings are a reflection of the company has managed its costs more effectively. The company has generated more customers over a given time period. They've sold more products to the customers that they already have and are capable of growing that. Low quality earnings, on the other hand, are just incidental to the markets that they happen to be operating in. Right? So when you are evaluating a company's financial statement, looking for quality earnings, which is really expressed through MD&A discussion, is going to reflect how much value is actually being created or destroyed by the company's actions, and that are not just happenstance to the economic environment. Right, this is a really key distinction between well and poorly run companies. If a company's performance just happens to be because of the market they operate in, that doesn't necessarily mean that the company is being run well. Right? And people often confuse those two things. It's not uncommon to see a lot of fanfare over a company's performance just because they happen to operate in an industry that is particularly profitable in a given time period. Right? Really good example being the run-up in prices of semiconductor manufacturers a couple of years ago. Right? There was a huge supply chain crunch. Demand for those processors increased, especially with the increased computing demands from AI development. And prices of, I think it was NVIDIA, AMD, and I think Microsoft were the three big companies that happened to have their stock prices increase significantly over that time, only to come down shortly thereafter because it came to realize that, right, this was just a function of the markets they're operating in. It wasn't reflection of improved operating performance or improved conditions of the companies themselves. Keep this in mind, the difference between the quality of the earnings themselves and the reported information, right? And they are closely related because you need quality information in order to gauge the quality of earnings, right? We need high quality information in order to value a company, to value an asset. So we need both. Hopefully, companies that you're evaluating have both. And it's important to be skeptical of companies, especially when the quality of their reported information is suspect. All right, so how useful is the information that we're dealing with? Right, so we have the differences between the quality of earnings and the quality of the earnings report itself, the financial statement. And we really just want to keep this information in mind as we're evaluating the financial statement. Right, so the quality of the earnings report reflects value from information. So we need the information from financial statements to make decisions as financial managers. Has the changes that we have made for the firm resulted in positive cash flows, negative cash flows, or no significant change? And we also have to evaluate the quality of the earnings themselves, right? So are these earnings likely to continue in the future? Right? Are they not incidentally generated? Or are they from actual material changes that we have had that we have made for the company? Right? So a great example is going to be currency conversion. A footnote that you'll see in a lot of companies that have any sort of international operations is changes in currency can have significant changes on their profitability in over market segments. Right? But the change in currency is not a reflection of operating performance of a company. On the flip side, if companies are engaging in effective investment, if they're continually expanding their capital expenditures and investing in value-adding resources, resulting in higher cash flows after those investments are made, then we are looking at quality earnings because it's the operations of the company that are resulting in its growth and revenue. Right? It's not just an incidental result of the economic environment they're in, but it's from true changes that the company has engaged in, decisions that people working at the company have made, resulting in improved cash flows. So the big takeaway from this is $1 in quality earnings is more valuable than $1 in low quality earnings. Right? Quality earnings are something that are going to be consistently generated over time. If a company is producing a valuable good or service that consumers are going to want to continue purchasing, we should see the cash flows from their investments increasing over time. However, low quality earnings can change just as quickly as they resulted in the increase in or the earnings bump. The US dollar has appreciated significantly against something like the euro over the last 5 years, I think now. Right? But prior to that, the euro was appreciating. Right? So currency conversions are a big factor affecting a company's cash flows, affecting its income, but they're not necessarily a result of any significant change in operating performance. Right? So when you are evaluating companies, try to look out for companies that are generating these cash flows from operating changes, not necessarily environmental changes. And keep in mind, though, all companies will have the environmental effect. Right? All companies are going to be affected by inflation in one way or another. But try to dig through the financial statements to determine what proportion of the cash flows being generated are from operating improvements, or are they from just the happenstance of the environment. All right, so companies need to provide valuable information. They need to be useful and able to value the asset themselves. But there are changes that occur with financial statements, right? So, for example, there are mandatory changes. If the regulatory body changes some guidelines for a particular accounting standard, companies are going to have to change that as well. Right? So there are times when companies are told that they have to change, and sometimes companies will choose to change. Right? So if they think that there's a more appropriate way to expense their inventories, maybe they'll make the switch. But even though companies have the ability to change, companies are expected to remain consistent over time by both regulators and investors. Right? So we are going to be talking about changes here, but they're not the norm. Right? It's not uncommon to see an accounting change, but very often companies will try to stay consistent over time. And as new information becomes available that materially changes financial statements, those statements are going to have to be updated, either through revisions if it is just an updated amount of information that companies have, or through restatements if there were significant errors in previously issued financial statements. And whenever this information changes, companies have to file reports that show how this change will affect the company's bottom line, right? The bottom line performance of the company. All right, so on the smaller end, we have revisions. So this is a change in financial statement in subsequent financial statement reports. All right, so they're not reissuing the entire statement. It's just in future financial reports, they're updating previously released information. All right, keep in mind, all accounting reports are based on estimates of performance. All right, if you dig into companies' values, they're very often rounded. Sometimes over future time periods, maybe it was a little bit lower and they should have rounded down, or they didn't account for enough of the revenue they generated and they have to revise upward. All right, so revisions just are changes in previous financial statements in future issued financial reports. A restatement is an entire reissue of a previously issued financial statement because of a material error. All right, so these are similar, but they're distinct. Because all restatements, they have revisions, but not all revisions are restatements, right? So basically, a revision would be a smaller change than a restatement would be. All right, so all restatements will have revisions, but not all revisions are restatements. Very often, restatements are poorly interpreted, right? Typically because restatements are often to the downside. So when a company restates a financial statement, very often the operating performance reflected in that financial statement will be lower. And broadly speaking, this can reflect negligence on the part of management, so they didn't do a sufficient job with their accounting practices to value a company, or it was strictly through dishonesty. Right? So companies were intentionally misleading in their financial statements. It was caught at some point by an accountant, and then they had to restate. Right? So very often restatements are poorly interpreted. Usually when there's an announcement that a company is issuing a restatement, the average return for that announcement is about negative 9%. So markets react pretty strongly when a company announces a restatement. Right? Again, either because management were sufficiently negligent that they didn't get enough information captured in their financial statements, or management was intentionally dishonest. Neither of those are a great situation, but between them, being intentionally dishonest is probably the worst situation. And it typically is reflected in the company's share price performance around this time. When companies are dishonest, their average performance declines. So revisions are not uncommon. It is not uncommon for companies to revise previous financial statements in future ones because, right, but due to financial statements being estimates themselves, over time, as they gather more information, they include that information in their financial statements and update it over time through the revisions. Restatements are relatively uncommon, though. Right? Of the thousands of publicly listed companies in the U.S., typically a relatively small fraction of them are issuing restatements over their time. And especially now that there is significant cost to being intentionally dishonest. If an executive is caught being intentionally dishonest, there are both monetary and potential jail time for engaging in that dishonesty, depending on the degree of it. All right, so companies can change accounting methods. The biggest issue with this is it's going to result in distortions of year-to-year comparisons. Right? So when we talk about taking those financial ratios, looking at the operating performance of a company, of their incomes relative to the revenues, that comparison can change over time if companies are changing their accounting standards. If companies are issuing restatements or revisions, this can change your prior analysis, right? It can go from a buy decision to a neutral or sell decision, depending on the degree of difference over time. Right? So it's really important to keep this in mind because changes are going to result in differences of evaluation. So whenever you're engaging in any sort of analysis, keep this in mind, especially if you're tasked with evaluating a company over time. You're going to have to update your financial statements to consider whether or not you're still making the best investment decision. All right, notes to financial statements. There are a lot of information contained in financial statement notes. These are some of the larger components of it. Right, so summary of significant accounting policies. It's basically what it states. Right? Key accounting policies of the company. They'll detail exactly what they consider revenue, how they expense inventories, how they look at expenses incurred over time. So a lot of description on how the company actually goes through each line item and describes it. There will also be information on subsequent events. Right? So these are material events that occur after a reporting period, but before the financial statement is released. Right? So depending on your company, they may report in, say, January for the previous year. Right? That will be the end of their time period, but that January report may not come out until June. Right? So in those months between when the financial year ended and when the report is released, some material event might occur that will affect the performance of the company, and they'll release this information in the notes to a financial statement. They also might bring up related party transactions, so any arrangement with other companies that's materially affecting the company's performance, and expected to affect the company's performance in the future. All the information we're trying to get out of financial statements is for decision-making purposes. It is more difficult to make decisions if you're bogged down in information. Right? So this class in itself, there's a lot of information contained in it. I'm trying to boil it down to the most important bits. It's the same idea with financial statements. You need the most important bits of information. That's where you're going to be that's where you're going to be making your decisions from. So as best as possible, it's important that financial statements are easily readable. And part of the motivation for these notes to financial statements is we can separate the most important information to details about that information, right? You don't, as an investor, you don't need every detail for each line item on a company's financial statement. If they're being reported to GAAP standards, then there's already a floor for the quality of the reports that you're looking at. So that information, it's going to be important if you want to dig into especially changes to financial statements, but you don't necessarily need it to get the cash flow picture for a company. Right? In order to calculate the company's cash flow, you need their income statement, you need 2 years of balance sheets. That's all you need. All of the other details may be important for verifying this information, but you don't need it to get to the bottom line goal. So, to keep financial statements as clean as possible, notes provide all the additional information that investors, regulators may need, but aren't necessarily relevant to bottom line decisions. All right, so all of that information that might bog down readers can be separated into footnotes and notes to financial statements, just to make it a little bit easier to read. Right, and as we'll see when we take a look at Walmart in a minute, there's a lot of information in the footnotes. Not all of it is necessarily relevant, though. Right, this doesn't mean that notes aren't important. There can be material information in there. There is additional information that just helps provide more details on what you're reading through the financial statement. Right? Just because it's in a note doesn't mean it's unimportant. And there's often more notes than there is in financial statements themselves, right? As we'll see, the financial statements of Walmart take up a couple of pages. The notes to those financial statements take up, I think it's 15 to 20 pages of the financial report, right? So the notes can take up a lot of informational space, but in order to keep concise and clear information available to regulators, to investors, to managers, we can kind of break that information down in separate stages to avoid overloading the analysis. All right, so we're going to look at Walmart's 10K now. All right, so I brought it up. All right, so at the top of the financial statements with supplementary data, that being the note section, all right, it starts off with some information from the accounting firm. Typically, it should result in them basically saying things presented in the financial statements reflect reality as accurately as possible. Right, and that's basically what is summarized above. Yep. So the top line presents fairly in all material aspects the financial position of the company over the time period that is supposed to be reported. Right, that's what you want to see in this little aside from the auditing company. If there are any significant issues with it, that might make a little more suspect when you're looking through the financial statements themselves. If the auditing firm does not believe they reflect reality, then you might have some problems with the financial reports themselves. So this brings us to information of the financial reports themselves, right? So we have the income statements, balance sheets, shareholder equity, cash flow statement, and that brings us to our notes. All right, so generally what the company is about, it's consolidation, right? Consolidated financial statements are what we're looking at. This company's largest segments are Walmart, the company stores in the US, Sam's Club, and international retailing locations, right? Those are the three largest components. They're all consolidated in these consolidated financial statements. That's why we have that term. Right, and then it's breaking apart information that it's details the reports, right? So good example, cash and cash equivalents, right? So investments with a maturity of 3 months or less are considered cash and equivalents. And then they break it down that sales made on credit and such are reflecting cash equivalent for the company. One important footnote to this is cash being tied up in foreign markets, right? And they note here, right, may not be freely transferable to the U.S. due to local laws or other circumstances. Right, so this is an important distinction to keep in mind, right? Are the cash flows that your company generating somehow tied up in markets where they can't benefit the company's largest segment, right? So basically 3 to 4 billion of cash tied up in foreign markets. Is that good or bad? It depends on the company, the size of it, and if they can still use that cash for productive purposes in the markets where the cash is located. All right, we have details on how they put together other current assets for the company. So inventories, they have different ones across the various segments of the company. This is important for cash flow implications and how exactly the company puts together its inventories. Right, LIFO accounting, last in, first out, or are they using FIFO, or what they term in here retail inventory method of accounting, or an average of them. Right, so their Sam's Club aspect uses a weighted average cost of LIFO, so they can use different methods in different segments of the company, and then just average that out. It gives detailed information breakdown on subsets of the report. Right, so property and equipment, how much of that is the raw land itself? Right, land doesn't have a depreciating value. Land is land. However, when you build on land, so buildings and improvements, there are time frames there. Right, every building depreciates over time. It needs repairs. It needs to be taken care of to continue operating. So that's going to be reflected in this information here. how much of their property, plant, and equipment is tied into these different types of assets. This is an interesting tie into another class you might be taking, their use of derivatives, right? In any derivatives market, there's basically two types of market participants. There's the speculator, the person expecting markets to, or price of an asset to increase or decrease over time. Then you have the hedgers. A lot of the public companies are going to be hedgers when engaging in derivative and security markets, because basically what they're trying to do is they're trying to stabilize their cash flows over a given time period. And derivatives are one of the means to do that. Right? So when companies engage in derivatives, very often it's for hedging purposes, and they'll detail what exactly they use those derivatives for in order to stabilize their cash flows. And the last thing I wanted to point out here is how exactly they recognize revenue, right? So here they detail, we look at our sales net of taxes, right? When you pay, say, $20 total for an item, a part of that is going to be sales tax, right? So that sales tax is deducted from the company's revenue. So you might be paying $20 to the company, but of that, your 10% sales tax is not included, right? So that $2 is going to the government, the rest is going to the company. Right? And one important thing that it notes here are, there it is, estimated sales returns. Right? So companies have to have a decent idea on what proportion of their products are going to be returned or defective or something like that. Right? So when they make a revenue, it's not just the revenue itself, but what's the probability that you're going to return this? What's the probability that something is wrong with this product that's being sold to them? Right? And this company has an allotment for that. And there's estimates that they have to put together for what's a reasonable amount of a sale that's expected to be returned over time. Unfortunately, they don't include details on how they determine those estimated returns, at least that I could find. But that's just important that companies have an idea. All right, so there's lots of information contained in the notes to financial statement that detail each of the line items. Some of it might offset your understanding of the company's cash flow performance, right? If a lot of their cash flows were just due to hedging derivatives, say, does that reflect good performance of the company? Does that reflect them making significant, solid management decisions? Or is it just incidental to the asset, right? There are a lot of details contained here. Not all of it, again, is relevant for getting the cash flows. Some of it might be. Are the company's cash flows tied up in foreign markets that they can't return from overseas? Stuff like that. So you can ask yourselves these questions, go through the notes to financial statements to get further detailed information about the reported statements. One last thing I wanted to look at. Oh, sorry, two last things. There we go, segment section. So what we're looking at here is the company is breaking apart with further detail the performance across different segments. Right, so again, the largest breakup, Walmart, it's International, and then Sam's Club. And then within each one of these sections, breaking up the performance of the different areas. Right, so revenues, both in the US and outside the US. And then further disaggregations. So how much of the revenue was from grocery or general merchandise, right? And in foreign markets, which were the markets that contributed the most value, right? So the notes contain a lot more information about the inputs to the aggregated revenue that you're looking at for the company. Right? So you can dig into this a little further to get details on what might be the best operating subsets of the company. Is the company investing in those more value-adding areas? Right, so looking at this segmented information can provide more details. All right, lastly, changes, disagreements with accountants. There can be important information here, but hopefully when you're going through the financial statements, usually you'll see that there has not been any change in company's internal control. If there is, they should be reporting it here. But for the most part, companies will try to be consistent over time. If companies are not consistent on a regular basis, that becomes a lot more suspicious to regulators and investors. All right, so there are details in here. Usually it's one of those things where things are fine and you don't have to dig into it more, right? Most of the time you'll find there's not material changes and companies are just continuing to report that the way that they historically have. If there are significant changes, this is the place where they'll outline it and note how those changes are going to affect the key takeaways from financial statements that they have reported in the past and how it might affect them moving forward in the future. Any questions on financial statement notes? I know it's a lot of information buried in here, but the key takeaway is, are there any material changes? And you should look through this section to gauge if those changes are going to be affecting the company. Typically, you should find no change in the company's internal control. Right? If there is a change, how is that change affecting the firm? All right, so again, your last homework is going to be choosing a company to look through their MD&A, not included in your industry that you're currently working on for your project. Look through the notes that I left you in your grade for the last part of the individual section of your project. That'll point you in the direction of putting together a better summary of the MD&A. Any questions?